Buying a company without having sufficient knowledge of it may be even more dangerous than having inadequate diversification. Regardless of how high the rating may be in all other matters, however, if there is a serious question of the lack of a strong management sense of trusteeship for stockholders, the investor should never seriously consider participating in such an enterprise. Usually a very long list of securities is not a sign of the brilliant investor, but of one who is unsure of himself. Never promote someone who hasn't made some bad mistakes, because if you do, you are promoting someone who has never done anything. Companies that have failed to go uphill have invariably gone downhill. Large companies need to bring in a new chief executive from the outside is a damning sign of something basically wrong with the existing management. The stock market is filled with individuals who know the price of everything, but the value of nothing. More money has probably been lost by investors holding a stock they really did not want until they could at least come out even than from any other single reason. Investors have been so oversold on diversification that fear of having too many eggs in one basket has caused them to put far too little into companies they thoroughly know and far too much in others which they know nothing about. Be extra careful when buying into companies and industries that are the current darlings of the financial community. Practical investors usually learn their problem is finding enough outstanding investments, rather than choosing among too many. The job has been correctly done when a common stock is purchased. The time to sell it is almost never. In the stock market, a good nervous system is even more important than a good head. The successful investor is usually an individual who is inherently interested in business problems. The ability to see through some majority opinions, find what facts are really there is a trait that can bring rich rewards in the field of common stocks. It is not easy to develop, however, for the composite opinion of those with whom we associate is a powerful influence upon the minds of all of us. I believe that the economics which deal with forecasting business trends may be considered to be about as far along as was the science of chemistry during the days of alchemy in the Middle Ages. The greatest investment reward comes to those who by good luck or good sense find the occasional company that over the years can grow in sales and profits far more than industry as a whole. There is a complicating factor that makes the handling of investment mistakes more difficult. This is the ego in each of us. It is not the profit margins of the past, but those of the future that are basically important to the investor. In the field of common stocks, a little bit of a great many can never be more than a poor substitute for a few of the outstanding. The conventional method of timing when to buy stocks is, I believe, just as silly as it appears on the surface to be sensible. This method marshals a vast mass of economic data. From these data, conclusions are reached as to the near and medium-term course of general business. When do stockholders get no benefit from retained earnings? One way is when managements pile up cash and liquid assets far beyond any present or prospective needs for the business. The more successful the corporation, the more likely it is to be unique in some of its policies. If you can't do a thing better than others are doing it, don't do it at all. Constant leadership in engineering, not patents, is the fundamental source of protection. The company that doesn't pioneer, doesn't take chances, and merely goes along with the crowd is liable to prove a rather mediocre investment in this highly competitive age. Once a stock has been properly selected and has borne the test of time, it is only occasionally that there is any reason for selling it at all. The disadvantage of having eggs in so many baskets that a lot of eggs do not end up in really attractive baskets, and it is impossible to keep watching all the baskets after the eggs are put in. Forecasting is like trying to turn lead into gold. Even in those earlier times, finding the really outstanding companies and staying with them through all the fluctuations of a gyrating market proved far more profitable to far more people than did the more colorful practice of trying to buy them cheap and sell them dear. What is most important is that stocks are not bought in companies where the dividend payout is so emphasized that it restricts realizable growth. Paying a fancy price for something because of too favorable interpretation of basic facts is the investment fad of the moment. None of us likes to admit to himself that he has been wrong. Postponing an attractive purchase because of fear of what the general market might do will, over the years, prove very costly. This is because the investor is ignoring a powerful influence about which he has positive knowledge through fear of a less powerful force about which, in the present state of human knowledge, he and everyone else is largely guessing. Long-term investors best stay away from low-profit margin or marginal companies. The need for patience if big profits are to be made from investment. This matter of training oneself not to go with the crowd but to be able to zig when the crowd zags, in my opinion, is one of the most important fundamentals of investment success. When profit margins of a whole industry rise because of repeated price increases, the indication is not a good one for the long-range investor. I had made what I believe was one of the more valuable decisions of my business life. This was to confine all efforts solely to making major gains in the long run. The wise investor can profit if he can think independently of the crowd and reach the rich answer when the majority of financial opinion is leaning the other way. For the great majority of transactions, being stubborn about a tiny fractional difference in the price can prove extremely costly.